Stocks trade soft but ranged ahead of the union budget presentation on Sunday. Metals, energy and IT are big drags, while healthcare and industrials eke out gains.
Copper prices slide after the Chicago Mercantile Exchange revises up margins on trades by 20%, following an over 40% run-up in metals this year. And over 13% seesaw in gold also spooks investors. Metal stocks slide.
Swiggy takes a beating after it reins in growth amid a discount war, while Manappuram Finance slides as it continues to grapple with microfinance stress. But Dixon Technologies gains on hope of a Vivo deal, and Nippon Life AMC climbs on asset growth and market share expansion.
While there aren't any expectations on big announcements in the upcoming budget, as significant reforms have already been undertaken, there's hope of some revision in long-term capital gains tax to draw foreign capital. Will the FM bring cheer to the street? We'll know on Sunday.
Hello, good afternoon. You've tuned into Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, with me my colleague Sonal Bhutra as well as Ekta Batra as always. Sonal, Ekta, good afternoon. But today is the last trading session before we have the budget today. So important one to watch out for today, 25,200, a very range-bound trading session. We're not seeing any ups or downs in too much of a move, but a range-bound day coming in for the market.
It is, and we can't say TGIF yet because we are working on Sunday, but nevertheless, not much expected from the budget in terms of major populist measures, and that's been the word. But of course, what comes out remains to be seen. For the markets, we're above the 25,200 mark for now, but a lot of sectors which have been outperforming so far are seeing some profit booking. Metals, for instance, that's been one of the top losers today, so that index is down by 4.5%. IT is also giving it some company. If we talk about the mid caps, while the headline index is seeing some pressure, the advance decline ratio, that is in favor of the advances. A lot of earnings, a lot of news flow that we are tracking for you. And for now, the mid cap recovery is something that the markets will be tracking very closely.
Hi, girls. Yes, absolutely. You know, the day's high for today's trading session was around 25,323. So comparatively, it's been quite a choppy, volatile session, you'd have to say. But the broader markets are faring better at this point in time. We have the mid-cap index, which is up around 2.3% on a week-to-date basis, versus the Nifty, which is up around 0.8%. A lot of stocks in focus. Just want to point out a couple of them. South Indian Bank, which is down around 13%, so no respite, which is coming for South Indian. Vedanta, which is down around 6% post numbers. Vodafone Idea, just watch that stock go. It's up around 12% in today's trading session. And a couple of others which are moving around include Aurobindo, which is off today's high. But nonetheless, we have a lot to watch out for and a lot on the show in the next 60 odd minutes. So let's tell you what we have lined up. We'll be connecting with the managements of Borosil Renewables and Quest Corp. In our What's Trending segment, we'll be focusing on the expectations from the tax front as the government gears up for the upcoming budget on the 1st of Feb. Later on, we'll also bring you excerpts from our conversation with Hitachi Energy from the India Energy Week 2026.
Okay, all right. So that is what we are expecting on the show today. For the markets, as we've been pointing out, it's the mid caps which are slightly doing better than what the benchmark is doing currently. Couple of movers. We have South Indian Bank, which is down around 14% as we speak. Nifty is the other one, which is down 9%. A lot of profit booking in these metal names. Hindalco, for instance, is down 8%. Vedanta, despite good set of numbers and a target price increase from Nuvama, is also lower by 8%. But we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action. Stay tuned for that.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. It's turning out to be a bit of a dull day for the markets ahead of the budget on Sunday. But let's talk about specific companies now. Borosil Renewables is one company that reported what was a good set of Q3 numbers. And the revenue and the EBITDA margins came in quite healthy. So let's talk about a couple of focus areas with the management, from domestic demand trends to China reducing tax rebates for domestic producers, and an update on their German insolvency proceedings. We have with us Pradeep Kumar Kheruka, who's the Executive Chairman of Borosil Renewables, who's joining in now. Mr. Pradeep, thank you very much for joining in. If you could just start by talking about the margins, the India business standalone margins. They came in at around, I think, 30-odd%. What is the steady state margin picture for you?
As we all know, in life, few things are steady. The margins are no exception to that. I can only say that it is as steady as it gets, which means we are producing all that we can, we are selling all that we can, the prices are steady, courtesy of the minimum import price imposed by the government of India on imports from China. And our impression was that we should be getting about a 30% EBITDA. As it turns out, it's a little over 33%. It's about 33.4% for the last quarter. And the quarter before that was 33.2%. It's now 30.4%. We are working at the margins. We are trying to expand production, improve sales, do all the nice things we can. We are looking at getting supplies of electricity from a captive power installation sometime in February. And when that happens, then cost of power to the manufacturing will come down a little bit.
Okay.
It should give a little nudge to margin, hopefully.
So what you are saying, sir, is that at least 30 to 31% is where you have visibility as of now?
Yes.
But then with that power also, we'll see an improvement, right? If you're getting captive power and reduction, what would be that improvement that would come in then? How many basis points can we expect there?
I wouldn't like to hazard a guess on that, because as we all know, renewable power depends upon the sun, upon the wind. And these days we have renewable power, which is a combination of, it's a hybrid solution, which means some sun, some wind. And it would be nicer for me to mention that once we actually get it. But it should only add to the profitability of the company and reduce the cost per ton of glass. So that should look good.
Mr. Kheruka, your industry has seen a lot of interest now, right? You were the first mover, and then we've seen a lot of listed players here who've been speaking about oversupply, some realization issues. I wanted to understand from you, where do we stand as far as industry is concerned? Where are domestic prices headed towards, and are local module players now buying from you? What's the status here?
So the players who buy from us, of course, are they are beneficiaries of the government's great emphasis on installation of renewables. And so therefore, we keep on selling. They keep on selling and they keep on buying from us. That is one. The second question is about what's going on with the rest of the industry. So we already have, I think, about 6 players in all. And we have some more new entrants who are who are going to join us, who will be joining the Manufacturers Club very shortly. We can see Reliance coming up with 1,000 tons per day straight away, and a second 1,000 tons per day in a short time thereafter. So within this year, calendar year, I mean to say, we should be seeing 2 production lines, 2 installations of 1,000 tons each from Reliance. There are a couple of other companies also which are on the cards. And we are importing nearly 7,000 tons of glass per day, which is a huge amount. And even when 2,000 tons of Reliance comes in and the other players come in, there's still going to be a lot of demand left. So far as our position is concerned, Borosil has always been a customer-centric organization. We continue to try our best to match the requirements of our customers. And we've been fairly successful at doing that across the board. So this should not be an exception. We've been doing this for the last 15 years now, making glass for the industry. So I don't see any serious challenge to our situation here. The one thing that is happening is that a new furnace has been lit in Indonesia against which there is no anti-dumping duty so far. There's nothing against them. No, they have to first come into production. It takes a few months to stabilize, and then people test the glass. They test to see what's the transmission, what's the output of the module, and it's after that that people start moving in and start buying.
All right,
So
Mr.
that may
Kheruka,
take
just
anything up to 6 months.
a couple of more questions.
Yes.
Just wanted to touch upon the German arm, Geosphere,
Yes.
which is filed for insolvency. Can you
Yeah.
tell us what the latest is there and whether you've taken complete write-offs?
Yeah. So there are three things. Number one, we had set up a holding company which was registered in Germany. We never do treaty shopping. We don't like to do that. So we registered the holding company in Germany. The manufacturing company GmbH was owned by the German company. Now the German company Geosphere, which is our subsidiary, had to undertake to a local bank there, which is like a development bank, which had given a grant of, I think, about 4.3 million euros to GmbH for modernization. So that grant was taken by GmbH. It was utilized for the purpose for which it was taken. The equipment was purchased, the equipment was commissioned, and the results which we sought from that installation were all achieved. So it was like all the I's were dotted, all the T's were crossed, everything was perfect. And then the market ceased to exist. The market for GmbH had been the module manufacturers. I think the German government took a call that module manufacturing is not viable in Europe anymore, and they decided to not support our customers. And when that happened, we lost the market. We just had no market left. And therefore, we had to file for insolvency, meaning the company had to file for insolvency. When that happened, the bank which had lent the money, had given the money as subsidy, they said that one of the conditions had been that you have to run it for 5 years. The equipment that you bought after using the money, that 4.3 million euros that they gave. I mean, we'd given 35 million euros, they gave 4.3 million. But anyway, so we have sought advice from lawyers, and we have been told that we are in a force majeure situation where the entire industry has been wiped out. And it is no fault of ours, and therefore it's force majeure. We cannot do anything about it. But they still laid a claim on Geosphere to repay that 4.3 million euros. So then the Geosphere had no choice but to file for insolvency.
Take that point.
This has not added anything to our write-off, which we had already done back in June.
Got it. Yes, that is something that you had indicated earlier as well. Mr. Kheruka, always a pleasure speaking with you. Thank you so much for answering all our questions on the industry outlook and specifically about margins as well. We'll slip into a short break. Up next, we'll connect with management of Quest Corp to decode their Q3 numbers. Stay tuned for that conversation.
Welcome back to Halftime Report on CNBC TV18. Now, we're going to be putting the spotlight on Quest Corp. That's the next management for today on the show. They reported their Q3 FY26 numbers. A steady show that came in, but we saw the headcounts remain flat on a sequential basis, a reduction on a year-on-year basis. Now, to understand the outlook of the company going forward, we have Lohit Bhatia, CEO at Quest Corp, joining us right now. Lohit, good afternoon. Thank you so much for joining us on the show as always. I want to start by talking about the headcounts, which have remained quite flat on a sequential basis, reduction on a year-on-year basis. One, what was the reason behind this? Any uncertainty in demand with sectors? And what is the outlook now for Q4 over here?
Good afternoon and happy to be here on your show. First and foremost, I would like to call it an almost perfect quarter from Quest Corp. Perfect in quotes, almost underlined. And I will, in that will be your, the question that you've also asked. If you really look at it, we've grown about 3% this quarter on revenues to 3,930. We've grown 4% this quarter on EBITDA to our all-time high milestone of 80 crores. And this is also a 28% expansion year on year. If you look at our adjusted PAT also taking for the, the labor code event, That's 62 crores. That's 19% quarter on quarter up and 29% year on year up. This gives us an EPS of 4.1 for our shareholders for this quarter alone. That again is an expansion of 19% quarter on quarter, 29% year on year. We have a net cash of 325. Our board has recommended an interim dividend of 5
Sure.
rupees.
Lohit, we have all of those points, so we're just going to urge you to sort of
The almost part.
get
Yes.
down to the head count, which has been
Yes.
flat on a sequential basis. If you could
Q3
just give us more color on that.
Yes. So the perfect part I've already told you. Now I'll tell you the almost part. The almost part is that Q3 is a seasonal quarter. And you know this, that during Diwali, staffing companies hire more. Post Diwali, there is a technical ramp down by the customers for a brief period of few weeks before the new cycle begins all over again. This year, two events happened in Q3. Q4 was about Diwali. However, November, when the revamp and the build-up had to begin again, the government of India decided to make 21st November as the D-Day for implementation of the labor code. Now, when you have, after 78 years, such a massive event which takes place, every large corporate, including all the Q3 results you're seeing, paused for a moment and said, before we hire more talent, let us first understand implication of the law, the change that is required, what needs to be done to provisions and payrolls, and we will start again. So all the sales that we had done and booked for Q3 got shifted into Q4. So the event is a one-time event which kind of created a pause in the market. For something as large as this, I think we've still come out with flattish headcount, just about 500 up. I would still call it an almost perfect quarter.
So does that mean quarter 4 will be a perfect quarter since quarter 3 was almost perfect? Trying to understand sectoral outlook, BFSI has a big impact of labor code, so does IT. What are the trends suggesting now? They halted in quarter 3. Do you think they'll pick up in quarter 4 and quarter 1 of next fiscal?
Yeah, great question. Early signs that we are seeing from customers in the month of January itself, whatever was deferred in Q3 is coming back as sales orders and deals and transfers in January itself. We expect this to pick up more in February and March, as most of the companies which have reported their results have already taken provisions and baked in for the additional cost. I must also say this is a reset as far as India is concerned on code on wages and the way the wages will be done. So it will be business as usual going forward, and it will continue to gallop. Now, I'll come back to the specific sectors that you spoke about. While two of them in our three lines of businesses have been clear outliers in terms of good results and numbers, our professional staffing, IT staffing has delivered a 12.5% EBITDA margin and a 42% growth on year. Our international has delivered a 7% EBITDA margin and a 26% year-on-year growth. If you come back into the general staffing business, there is a mix of volume business on one side and a value business on the other side. It's the volume business which got impacted, which is consumer, retail, telecom, and banking. Whereas our value business, including manufacturing, actually grew 4,000 even in quarter 3. That's not visible because overall the numbers have been flattish. Now, manufacturing is an India story. It's been doing well in the last couple of years. It's now 80,000 of our 483,000 book. And this is some place where we continue to deeply keep investing, along with newer segments like construction, which again is a long-term play for us.
Right. We're going to leave it on that note. It's been a pleasure, but we've completely run out of time, Lohit. More details the next time we speak. But thanks very much for joining in and speaking with us. So headcount has been flat on a sequential basis. Labor code impact has impacted Quest Corp this quarter. That stock up around 2.5%. We'll take a short break. On the other side, we'll bring you excerpts from our conversation with Hitachi Energy from the India NG Week 2026. Stay tuned. Welcome back. Well, definitely a dull day for the markets, and a couple of stocks which are in focus, like we mentioned, which are bucking the trend include Vodafone, which is up around 12% grow, which is up around 2.5% in a dull market. But do watch out for the Tata Silver ETF, Gold Peas, Nippon India Silver ETF. All of them are seeing sharp downtakes today. So there is profit taking which is coming in, considering that there is some amount of profit taking which is coming in terms of gold and silver prices. So sharp downtakes of anywhere between 7 to 10% as of now is what you can spot on a couple of these. But time now for some excerpts from the India Energy Week 2026. Manisha did speak to Hitachi Energy's N. Venu on energy transition, the role of AI and more. Listen in to a slice.
AI, especially, data center. Data center is all about, it's like a factory, right? The input is energy and output is AI. So the more AI means more energy is required in that, and we power the data centers, and the critical challenge for this is to ensure that the supply chains are really created here, and then we need to have robust supply chains for powering these data centers in that. Yeah.
So how are you as a company adopting to all of this infrastructure needs?
Absolutely. Again, we have seen this coming in much ahead of the curve, and we started investing it. And we announced in 2 years before in our 75-year celebration that we are spending 2,000 crores in the next 3 to 4 years in augmenting our capacities, in putting in greenfield factories and also brownfield factories. And we are really super excited about this demand, and then we are taking care of those things in that.
So there are a lot of targets with companies and countries as well. But with 2030 sustainability target, where are you right now as a company, and do you see any hurdles getting there?
I think when it comes to the 2030, Hitachi Energy has our own sustainable targets, and we want to be carbon neutral in all our operations by 2030. We had our first milestone, that is that all of our factories and the project officers should be fed through the renewable power. We have achieved 1 year ahead of the curve, and now we are doing the rest of the things. In my view, I think we are well ahead of the curve to reach our targets by 2030. And similarly, we are not only in our own operations, we are helping our customers, we are helping our other partners to ensure that they also reach these sustainable targets.
But are there any hurdles there on the way?
Of course, it's not easy task, but it's definitely a lot of hurdles, especially in the MSME sector, everything. When you're talking about our own sustainable targets, we need our partners also need to come up with that.
Yeah.
And that's where is a challenge. So we are working with our ecosystem to ensure that they also come up on that.
I was reading somewhere that Hitachi is approaching or adopting to program-based rather than project-based. How is that working for you?
As I said, the demand arising out of these new forms of the load, for example, the data center. For a data center, you need at least minimum 6 to 8 times more energy required compared to the conventional thing in that. So with this kind of demand, it's not possible to predict the load. You need to have, much better vision, at least, minimum 5 to 10 years in that. And then you need to move instead of, every project-based approach to a program-based approach. A program-based approach will take you much longer view, longer vision, so you can plan better, you can invest better, so you are able to also take care of the whole ecosystems end to end in that. So that's what we are really articulating with all the policymakers, etc. Move from project-based approach to a program-based approach.
How does India look to you in sense of growth going forward, and these various FTAs and BTAs India is doing? How does that impact you?
India has a scale. Okay, India is offering a scale. I give you 2-3 examples of that, especially on the energy sector. It has a 500 gigawatt of a renewable target by 2030, and I've just saw the press release of the MOP that they had another 100 gigawatt of the pump storage target. All these things adding a huge amount of opportunities for a company like us, and then we are super excited, and that's the reason we are investing in terms of the people, investing in terms of our capacities, and we are bringing the technologies and localizing those technologies so that we are also complying Make in India, and all those things will add a lot of opportunities for all of us.
One final question, and what policies would you require to get to on where you've started on?
I think one of the things where we are really looking forward is to continue the policies and then add a little bit more on that, because energy transition has been recognized as one of the key elements in the progress of any country.
And it's a long-term thing.
It's a long-term thing, and then we need to have those kind of things kicking in terms of whether it is policies of adding the incentives or ensuring that bottlenecks removed. All those are regulatory things. We are looking forward to that.
What's your sense also on the macro dynamics right now? Because that also seems to be troubled waters.
I think India, yeah, it is. But India, I would say, in the troubled waters, India is so far is looking good. Okay. I would say you see the GDP growth is really good, and all the indicators are showing the growth, whether it is industrial growth, whether it's energy consumption. In my view, I think the challenges could be ironed out over a period of time. If you're talking about whether it is a trade deal with the US and other things, I'm sure it'll happen over a period of time. But right now, at least our business standpoint, all indicators are shooting in the right direction.
Okay, an interesting chat there with Hitachi Energy. But on that note, we're going to slip into a very short break. And on the other side of the break, we'll come back with our What's Trending segment. We'll focus on expectations from the tax front as the government gears up for the upcoming budget on 1st of February.
Welcome back. You're still tuned into Halftime Report, and this is our What's Trending segment. And what is trending other than the expectations ahead of budget? And that is what we'll be discussing on this segment. On the indirect tax side, of course, the focus remains on tariff rationalization, correcting duty inversions, and easing compliance through digitization. On direct taxes, expectations on the implementation of the new income tax regime, TDS rationalization, and around demands around capital gains and dividend taxation as well. To break down what's likely, what's aspirational, and what really matters for businesses and investors, we are now joined by Himanshu Sinha, Partner Taxation at Tri-Legal, and Uday Pimprikar, who's Partner and Indirect Tax Leader at EY India. Uday and Himanshu, thank you so much for joining in. Even in the economic survey yesterday, the main points was how to attract more FPI flows now. And the second was Make in India. That was the big talking point. So the questions are from that angle. On the direct tax side, do you think there'll be some measures to attract more FPI flows in the country? And from the indirect tax side, do you think there'll be customs duty rationalization? Himanshu, let me begin with you. Then Uday, you please come in on this.
Yeah, thank you for having me. So on this aspect of the emphasis of the government on inflow of investments, I think the government's focus more is on FDI rather than FPI, because government's priorities lie more on the side of employment generation rather than capital inflows, because government feels that the domestic retail investors are pumping in sufficient amount of money to offset the exit of FII money out of the Indian capital market. So I would say it's a low priority item in my view, and the higher priority item is to promote growth and generation of employment, especially in strategic sectors. So there might be some incentives which people are expecting, and there might be government announcements to that extent, whether in the form of tax holidays for entities which are other than eligible startups, or additional depreciation for investments in order to promote capital expansion and employment generation. So some kind of tax incentive, either by way of additional depreciation or some kind of tax credit or some kind of extension of tax holiday may come about.
Uday, coming on this, what's your take on the Make in India conversation that has been happening around now? Any rationalization is what we're expecting?
So I look at it slightly differently, Sonal. The budget now, from an indirect tax perspective, is primarily kind of focused on customs and, of course, an avenue to kind of implement GST decisions. But from a policy perspective on the customs side, at a generic level, they have kind of gone about building a journey which they have kept to it or been consistent with. So this journey of tariff rationalization started about 3-4 years back. They've done a lot of work. They made some legislative changes about 3-4 years back, whereby they looked at all the exemptions over the last few years. About 450 to 500 exemptions have been kind of amended, reduced, all of that has happened. And over the last couple of years, they have been kind of looking at simplifying the tariff structure. And the primary drivers for customs bit is to, as you rightly kind of pointed out, Make in India, removing inversion, making India investment friendly, handling kind of procedural and those kind of things on the customs end. And so is the case, I think, to my mind, on the GST. And this is a market departure from what was there earlier, where customs used to be looked at as one of the avenues to increase revenues. It's no longer so. Okay, the average rate, the overall number of tariffs have actually come down from 21 to 8 in 3 years. And we would expect some bit of that to continue. And also the fact that the rates have been kind of moved primarily to align with the PLI and other kind of factors and incentive mechanisms that have been given by the government. And that particular journey, to my mind, will continue and be consistent with.
All right.
As we go along.
All right. Himanshu, just wanted to get down to what the equity markets are possibly vying for at this point in time. What is the expectation, or what is the, in terms of the expectation, do you think that there could be any kind of tweaking when it comes to LTCG, dividend, buyback tax at all, STT?
I think that these aspects have been part of the wish list by the stakeholders, in the equity market. But I would say it would be very optimistic, overly optimistic, that the government would oblige and give further benefits, given the background that past year the government had announced major tax relief for individual taxpayers. Across the board, we all know that up to 12.75 lakhs salary taxpayers were sort of exempted completely. And then we had a GST tax rates rationalization, which has led to significant amount of increase of purchasing power in the hands of the individual households. So given that backdrop, I'm not too optimistic. Of course, it's part of the wish list. I'm not too optimistic on any kind of LTCG relaxation or dividend taxation relaxation or STT sort of rationalization, etc.
Uday, I just want to ask on a couple of points. Litigation, compliance, those have remained a bit of a pain point when you talk about indirect taxes, right? So how significant maybe during this digitalization of customs litigation process could be, and is it the right time for such procedural reforms to come in now?
So there are two aspects on the litigation front. One aspect is the litigation quantum itself. Okay. And there was a Rajya Sabha and an answer to the Rajya Sabha question that came about 6 months back. And that indicated a couple of things. One is that the customs litigation is actually, in terms of number of, let's say, appeals or whatever, has kind of gone up by 20% over the last year. But the overall value of litigation has actually gone up by about 70-80%. So as per that particular answer, 95 to 95,000 crore of litigation is pending at on the customs end. And so the ask of the industry, and I think we might see some kind of action on that, is on getting some kind of a dispute resolution scheme, or to kind of reduce the quantum of these disputes. And what if that happens, then any dispute which is not related to pure smuggling or narcotics could be kind of open for getting settled, and some scheme coming up there. And there is a definite need for that. So that is one aspect on the litigation. The second aspect on litigation is this entire administration of managing this particular litigation piece, which is not only relevant for customs, but also for the other taxes in general. But on the customs side, they are definitely looking at making things easier by getting the entire customs administration on a platform, the way we have in GST, and implementing it. To start off with, they will kind of look at getting some kind of API functionalities for doing day-to-day kind of compliances, such as filing of bill of entries and so on and so forth. That should happen. But over the next 6 to 9 months, or maybe about a year, they would want to kind of onboard the entire administration on compliance, on the rest of it. Already, faceless assessments is kind of happening. And I think this will just, as an activity, move ahead.
Okay, Uday, it's an interesting conversation, and there's been a lot around customs on different social media platforms as well. But you have to cut across to another panel that is happening on budget. So thank you, Himanshu and Uday, for joining in. Let's cut across to another interesting panel at the Budget Vision 2026 with top policymakers Vivek Johri and Akhilesh Ranjan.
Ways of taxing capital, which is not productive, which has a disproportionately low income component attached to it. There are many theories, many research papers brought out on this. Something has to suit the Indian context, but something needs to be done. I think policymakers must look at that.
Mr. Johri?
I think one of the things that has worked well and should continue to be pursued is data triangulation. And now that the economy is digitalized to such a large extent, particularly government systems, so you have customs, you have income tax, you have GST, the databases are speaking to each other. We're exchanging notes on, taxpayers who are here but missing there. So what kind of returns they're filing, the quality of returns, and so on and so forth. So I think data triangulation will only sort of grow over time. And maybe, I don't want to use jargon, but maybe AI and ML will also be used to, interrogate this data better. So I think that is something that holds a lot of promise in the future, for better tax compliance and increasing the taxpayer base. Also, I think the quality of data is an issue. And I don't know about income tax, I'm not qualified to speak about that, but indirect taxes, particularly customs data, even GST data to some extent, how good it is in quality, we really have to test and see. So I think there should be almost a mission launched by the government on improving and assessing data quality in our systems, because that speaks to interoperability of systems and being able to exchange data with each other. The third thing that I think needs to be done, and that's in-house, it's already being done, it's not as if the government is not paying attention to it, but I keep saying this, train your officers even more, because new skill sets are needed, new ways of dealing with taxpayers are needed, and no amount of training falls short of what we need, particularly when it comes to transparency and fairness. I think these are values that we need to internalize, much deeper in our systems. So,
well, thank you, gentlemen, for laying out a roadmap on what we should expect, not just in the budget. You've given us some very specific recommendations of what you expect the budget to deliver on, but more importantly, laying out for us a medium and a long-term roadmap. To your point about, LLMs and AI, I hope we don't have data being uploaded onto ChatGPT. We should perhaps wait for our sovereign model, which we expect will be launched in February at the India AI Impact Summit. But Mr. Ranjan and Mr. Johri, we'll have you back on Sunday, Super Sunday is what we're calling it, the budget day, to see how much of what we've spoken about here is translated into action when the Finance Minister presents her budget. Thank you very much for your time. Ladies and gentlemen, a big round of applause for Akhilesh Ranjan and Vivek Johri.
Thank you
so much,
Thank
sir.
you.